So first of all, thank you very much for your time today. What we're going to do today is cover quantifying entries, which I think is probably one of the very most important things that you can learn to do. We'll also talk about the right-click menu, which has a lot of functionality. And then we'll talk about customized questionnaires. And once again, we'll go back and visit the main bank account. When it comes to quantifying entries, I just want to remind you that if you go to support and if you go to entry basics and types of help, I think two of the very most important videos that you can play are the 5 types of help, just to keep reminding yourself of what's available. And then this video, the main types of entries. And that's what we're going to spend most of our time on today. So I'm going to open VisionWorks. There are 3 basic types of entries. We call them static, discrete. They happen at a point in time, like renovating the kitchen, or ongoing. There's something that continues over time, may end at some point, may not start till the future, but basically it continues over time. So just to illustrate the idea of a discrete entry, I'm going to use the buy-sell panel for a home. And what you can see here is that there are fields to complete. When did you buy it? What did you pay for it? What's the current value? And for these static types of entries, there is only one possible answer. There can only be one purchase date, one amount you paid, and one current value. And I just want to compare that with what other software does, which is it has these entry fields, but they're entry fields for data that can change over time. So if you look at this example, lifestyle needs, there's the ability to enter a current lifestyle expense and then one during retirement, but nothing in between. In other words, not changing vacation expenses over time and so on. So when it comes to these static entries, static, only one possible answer. And I want to remind you about the help button. And just to emphasize this, I'm going to Bills tab, I'm going to go down to other assets and employee share purchase plans. And what you'll see when you click details is that this panel is a static panel, meaning that there are many different fields to be completed. So you're going to see different variations of this, quite a few for all the different things that VisionWorks, CorpWorks, and TrustWorks can model. So it's very important that when you're looking at these types of entries, that you click the help button, and you'll remember you'll get some overview commentary. But when you click see also, what you'll get are all the step-by-step instructions that will walk you down through what you need to do for all the different fields. So whereas other entries tend to have this discrete and ongoing entries tend to have the same, what I'll call look and feel, the static panels are ones that are very specific to the thing that you're modeling. So you want to really make sure that you remind yourself to use help. So let's go back to our house. So as we mentioned, the first type of entry, static entry, fill in the fields, make sure you click help, make sure you click see also to know how to complete those different fields. The second type of entry I want to talk about is a discrete entry. And the classic example of that is something like renovate the kitchen. So what this basically says is we're going to have an expense at a point in time, and that expense is going to be like a lump sum outlay, the kitchen renovation or whatever. Now, there are a few ways that you can quantify these. One is that you can drag the entry on the panel. So, out to 2025, up or down in amount. And if you're dragging something, from $20,000 to $15,000 or $25,000, then that's relatively easy to do. But if you're talking about changing the default entry from $20,000 to $100,000, then dragging would be painful. So selecting a table and entering something in the table would be a much more efficient way to get that in. The other thing, so we have dragging, we also have typing numbers in tables. And I also want to mention, by the way, that you can change years by dragging from left to right, for instance. But also, if I open this year list, you can see that I can now select a different year and have that entry change. There is another flavor, if you will, of these discrete entries, and it really has to do with discrete entries that will repeat themselves over time. So I'm just going to use vehicles, and I'll just put in a car purchase as an example of this. So what we need to do then is we need to go to the buy panel and indicate the next time we want to buy a vehicle. So I'm going to go to 2025 and just select $50,000. I'll buy my next vehicle in 2025 for $50,000. Now notice what we also need to do in this particular case with vehicles is put in something to reflect what the current value of our vehicle is. So I'm just going to use $20,000. So we have a vehicle worth $20,000. In 2025, we want to buy a new one worth $50,000. And then what we want to do is we want to repeat that purchase, whether it's every 3 years, 5 years, 7 years, 10 years, whatever the client wants to do. So I'm just going to click the repeat button and say I want to repeat it every 5 years. And I'm going to use something like the next 50 years. So what you'll see then when I click save is that we have all these entries going way out in time. Now, what is happening in the background is that the current value of $20,000 is being depreciated, and we use the CRA rate so that if, for example, you're self-employed, all you have to do is click business use, and what will happen is your percent of any, for business purposes, of any operating expenses will be a business deduction, but also your percent of business use will also create a deduction for the capital cost allowance claim in the background. Not all of the vehicle obviously can be claimed, but a good chunk of it might be. So what's happening is we're taking the current value, we're depreciating it at the CRA rate, we're then trading in that depreciated value against the inflated value of the next purchase, depreciating it, trading that in against the inflated value of the next purchase, and so on and so on. So if I just go to net worth, for instance, then what you'll see when we drill into vehicles and we look at the car that we just added, you can see that the value of that vehicle is being depreciated every year, and that's being accounted for in any net worth statement. If you do a net worth statement, like a table that runs years into the future, when you look at things like vehicles, then it will reflect this depreciation. If you don't want to use the CRA rate for any particular reason, then one of the things that you can do is use other, and then other will allow you to put in whatever rate you want to put in. So you may want to put in a lesser rate than the CRA rate. And if you are dealing, for example, with something like an antique collection of cars, you can actually put in an appreciation rate so that the value of that vehicle is increasing over time. The one other thing that I'll just mention when it comes to things like kitchen renovations or additions on a house or even purchasing a vehicle, on the buy panel or the renovation panel for a kitchen, you'll see a financing entry. So just remember that generally speaking, except for personal lines of credit or term loans, that financing entries are usually created through the thing. And by sorry, I don't have a vehicle in here. By creating it through the thing, let me get rid of that. By creating it through the thing, we're attaching the financing entry directly to that thing. And there are all sorts of implications. Is it tax deductible, not tax deductible? So again, going back to our example of the business use checkbox, if we were financing this entry, a portion based on the business use we claim, a portion of the financing entry, the interest, that portion would be deductible for tax purposes. Now, I want to show you this for a couple of reasons. Before I do, though, I'll just point out that when we put in the vehicle entries, we then also have the ability, and I'm going to use the right click on the mouse. We also have the ability to get rid of future expenses. So maybe we decide the last vehicle we're going to buy is when we're age 75 and 70. And we'll drive till we're 85 and 80, just 10 more years. So one of the things that I can do is I can put in the final year as 2045. And what that's going to do then is it's going to control the last year I own the vehicle. And as a result, the last year I pay operating expenses for the vehicle. So we talk about itemizing vehicles in plans, which I don't believe other software does, at least not correctly. And the reason we talk about it is because it's not uncommon for homes or households to be, let's say, 2 vehicle families, but we don't want to throw vehicle expenses into general expenses, because if we do, we'd be assuming that the 2 vehicles are still being driven, until age 90 or 95 or whatever you're planning for. So we want to make sure that we're able to say, listen, we'll quit driving one vehicle when we're 70, and we'll keep driving the other one until we're 80 or 85 or whatever it might be. So we've talked then about 3 types of entries so far. We've talked about static entries, just fill in the blanks. Remember to use help, and see also, it will give you an explanation of what to do with the fields. We've talked about discrete entries like a kitchen renovation. And then we've talked about discrete entries that can be that can be repeated over time. And vehicle expenses would be, of course, the classic example. The other thing that I just want to do is we'll go back in and we'll add financing entries for these future purchases. And the reason I want to do this is so that you're aware, and this is typical of all financing entries that are created through the thing, that they're all linked together in the background. So if I go to finance and open up the different financing fields here, you can see we're financing a vehicle in 2025, 2030, not much of a difference. And then in 2035, again, not really much of a difference. And what's happening, as you can see, is that we're depreciating the existing vehicle, trading it in against the inflated value of the next vehicle, and then we're financing the difference. So if we go back to the vehicle purchase now, so we can see, the roughly around $45,000 in 2025, 2030, 2035. But if we go back to the vehicles now and say, well, we drive what we have now, but when we retire, we're going to get the elaborate car that we've always wanted to have thing. So we'll just make it $100,000, and then we'll save it. And now when we go to terms, what we see is the amount of that first vehicle financing is now considerably higher, because the financing entry and the purchase entry are directly related. If, for example, I delete the 2030 entry and we just have an entry in 2025 and 2035, now when I go back to financing terms, you'll see here when I open the list that we just have the 2025 and 2035 entries. So I refer to this as logical rules. If you change the price, then this changes automatically, and so on. If this is essential if you eventually want to start working with clients, because if, for example, clients have a financial shortfall, they're financing vehicles, and then they say to you, well, maybe we'll buy vehicles less often, spend less for them. Let's make that, because there are other things that are much more important to us. So let's make those entries for the vehicles just $40,000, and we'll spread them apart by, however many years that is, 8 years. So now all you have to do is change that. And then when you go back to the terms entry, you can see that the financing entry automatically updates with it. And that's something that's essential in facilitating collaborative or interactive planning. So the third type of entry that I want to speak about is what we call an ongoing entry. And of course, the classic example that I always use is vacations. So here we have a situation where we've put in, they spend $5,000 on vacations. And the underlying assumption is that they're still doing that when they're 90 years old, by which point the $5,000 is pushing $10,000. So I think it's really important that when we work with clients, we also explore things that will change over time. So as you well know by now, one of our big themes is that we talk about a dynamic database, the ability to change entries over time. In this case, we have an ongoing entry, the vacation expense, but we don't want to assume that we're spending $5,000 a year every year. And again, this comes back to the idea of having a conversation with people, working actually interactively with them. So what we're able to do is say, okay, you spend $5,000 now, but how do you see that changing over time? What do you mean? Well, will you spend more once you're retired, for example? Oh, sure. So I'm going to go to the first full year of retirement. Yeah, when we retire, we'd rather spend, $10,000. We'll have a lot more time. We'd rather go south for, much longer, whatever it might be. But again, we don't want to assume that we're spending $10,000 when we're, 90 years old. So we can just take that end dollar bill bundle, drag it back to, let's say, 80 and 75. We can end it there, or if we want, we could drop it down to $5,000, add another 5 years, and so on. And again, just remember that we can go in for 2022. The winter vacation time is over, so we really don't want to necessarily talk about having one in 2022. So I just opened the year list and started that vacation in 2023. So again, remember, you can use the year list to make changes. The other thing that I want to show you, because this is very important, this type of graph is what we refer to as, for an ongoing graph, as a step graph. In other words, there's an expense, it just runs along and then suddenly steps up. And it steps up because of some life event. Typically, it would be, we've retired, life's different, now we can spend much more than we or we will spend much more than we did before, we have more time. But there's another flavor for these ongoing graphs. And my favorite example of this is to talk in terms of a young professional. So I'm just going to drag the professional button onto the tree view. This would apply, for instance, to you in your business. You're building wealth by building your business. So there are many people that we work with for whom that's the case. So I'm just going to assume that Bill is a young doctor. He's 62 right now. So let's just assume he's much younger. And I'm just going to drag that out so we have some time. And notice the little steps in the inflated dollar amount. This is then a step graph. If I put in a change amount and drag that, it would go along and then suddenly step up. But what we want to do for the young doctor is try and capture the fact that over time, he's going to start earning more, or you are earning what you're earning today, and you're targeting something else for 5 years from now. So I'm just going to go down to 2026 and type in $500,000. And now we've got the same looking graph as we had before, which is to say that things go along and then suddenly step up. But in this case, we want to treat things differently. So all we need to do is click the graph type button. And notice the little steps in the inflated dollar line. We need to click the graph type button, and now we've switched from what we call a step graph to a gradual graph. And what we see is that the amounts are going up in equal annual increments. Now, I grant you that may not be how it works for the young doctor. Maybe in 2023, it'll go from 150 to 175. But the point is we can go in and try and capture how things change over time. And you'll notice then that the inflated dollar line is smooth, a gradual graph, smooth line. If I click graph type, a step graph suddenly steps up, and it's a step look for the inflated dollar amount. And again, just to remind you about help, if I click help and click see also, you'll see jump topics in here about step or gradual graphs and making ongoing entries and so on. So just remember that all of this is at your fingertips. So what we want to do next is we want to look at these graphs, and we want to also look at some things you can do with them, like indexing them and like who pays for expenses. So to illustrate that, my favorite example of indexing is property taxes. Right now, of course, we're assuming the 2% inflation assumption. So $5,000 a year from now becomes $5,100 and so on. However, you can control the indexation rate and make it be whatever you want. And you can see down here, there are 4 choices. Nominal, if we leave it at nominal 0, you can see at the bottom of the index by group box, that nominal 0 means no inflation, that $5,000 today, $5,000 in the future. Real 0 means no real increase in the expense or the income of something. It means just increasing it with inflation. So real 0 means no, if you will, purchasing power increase or future dollar cost sort of thing. It's just increasing it with inflation. Percent of inflation you can use, it's like 50% of inflation, or whatever it might be. So 5,000 becomes 5,050. Threshold is not used particularly often. It is mostly available if there are any DBPs that are private DBPs that are still in operation. And in their case, public company DBPs. It can be something like, if inflation exceeds 2%, that's the threshold level, then the entry will be, or the income that you get will be indexed. So in that case, if we put in 2% threshold, then what it would mean would be, if we're using a 5% inflation assumption, that 5% minus the 2% threshold would mean that the value increased at 3%. Since our inflation assumption is 2, then we're not seeing any increase. But if I were to put in a 1% threshold, then you can see that it's actually increasing at 2 inflation assumption minus the threshold 1 equals 1. So this is used in, or was used in the past in public company pension plans that were indexed, where they weren't matching, inflation dollar for dollar. They said, you have got to eat the first 2%, but after that we'll protect you. So where does this show up? Well, I think a very classic example for property taxes is our experience here in Toronto, and I'm sure in other major centers as well, where the indexation rate is actually going up much faster than our experience with the government stated inflation rate. So I'm just going to go in and reset all these nominal rates to nominal 0. Also, let me just do that down here. It's nominal 0. That's nominal 0. Okay. So if I go to 2022, I could put in something like, my experience living in Toronto is that property taxes are actually going up 5% a year. So you can put in, whatever you want to put in. Now, the other thing is you can change these entries over time, and this is extremely important to do. And the reason it's important to do is because you may have somebody who's in business and they say, oh, my sales are growing at 10% a year, 20% a year, whatever it is. Well, if you compound income at 10% or 20% a year, over many years, pretty much you'll end up having all the wealth in the world. So it's really important to be able to go in and say, okay, well, it's 5% today, but at some point in the future, make it, 2%, or make my indexation rate, 5% for property taxes or whatever it is, but, make some change, later in life. So you had that ability then to change things over time. The other thing we want to look at is the paid by table. Who's paying for an expense? And actually, to do that, what I'm going to do is use Bill Jr., again, sort of my favorite example. So you may remember that one of the things we talk about is that assets belong on the tab of the owner. Bill and Sue own the house. The example I always use for wills and estate planning purposes is that the cottage is in Bill's name, second marriage, blended family. So we put the cottage on Bill's tab. However, there are expenses, for example, that we put on the tab of what I call the doer. So in other software, Bill Jr.'s Go to University would be entered on Bill's tab or Sue's tab, or perhaps the joint tab. But we actually enter Go to University on Bill Jr.'s tab. He is the doer of Go to University. And the reason that we do this is very simple. When we put the expense on Bill Jr.'s tab and click Show Table, we can now go in and control who the payers are. By the way, if there's an RESP, the funding for the educational expense will come first from the RESP. And if there's any additional need to fund the education, then it will come from whomever we enter in the paid by table. But just as an example, because it's very commonplace in today's world, rather than Bill and Sue splitting everything, or Bill paying 75, Sue 25, or Sue 75, Bill 25, we can add a third party or more, and that non-party could, for example, be grandparents. Again, very common in today's world. So we could end up saying that, non-party grandparents are paying 50% of the education expense. Now, if we actually wanted to see the grandparents' names appear here, or even we could just go to the About page and add a party and call that party grandparents, then we would be able to see the name of the party in the paid by table. So if you want to see somebody's name in the paid by table, then what you need to do is you need to add them on the About page. But if you're just satisfied with saying somebody other than Bill and Sue is going to foot the bill, and it's understood that it'll be grandparents or aunts and uncles or whatever it might be, then you can just use the generic non-party. But this is very important. So one of the examples that I like to use, and I won't do it today, is imagine that we have a party called Bill Sr. Bill Sr. is 85. And again, I want to try and relate this back to real life. So Bill Sr. is 85. Bill Sr. owns the cottage, but Bill, who is still working and so on, Bill is the one who actually pays the property taxes and operating expenses on the cottage owned by Bill Sr. So we have this separation of who owns things, who pays for related expenses, who does things, who pays for those expenses, because that's just the way it works in real life. It's very commonplace for seniors to own assets like cottages, but to have their working adult children, pay the expenses. So let's have a look at general expenses. And I just want to talk about this briefly because they're quite different. If we click the details panel, you can see we've got Bill and Sue splitting expenses, and it's just going into the bucket called miscellaneous cash, $25,000 each. The reason for this, and you can see the different expenses, groceries, clothing, personal, etc., is that in the software, when we're dealing with any kind of an expense, let's just go to entertainment and a golf club membership, for instance, or go to the Jays games. When you're creating an entry in the tree view, it's a single entry for a thing. Go to the Jays games, belong to a golf club. But general expenses aren't a single entry. They're actually a basket of entries. And you'll notice under or down below, you can put in other, and you can type in something very specific, and that will then show up in the report, by the way. So this is actually a basket. And the reason we chose to do this as a basket is because if we were looking at, entertainment or general lifestyle spending, we don't want to have a button for, groceries, clothes, et cetera, et cetera. These are all things that we have over the course of our lives. We always have to buy groceries. We always have clothes. We always have personal expenses, manicures, haircuts, whatever it might be, or public transportation, or, the purchase of alcohol or whatever. So it's a basket. So the basket operates a little bit differently from individual expenses. So for one thing, if you want to change the split of expenses, what you actually need to do is you need to go in and change the weighting. So maybe Sue pays all of the groceries, maybe Bill pays, for something else, all of the alcohol, or maybe he's already paying for the mortgage or whatever. So people can split their expenses in different ways. So if you want to change the percent, you're actually changing the weighting of the specific expense that's in the panel. The next thing I want to talk about is the color coding system. So you'll notice here, for example, we added a vehicle, and you'll see that own a car is in blue. And you'll also notice, for instance, that the buy button is in gray. The buy button is in gray because we went in and quantified the entry. But what you see down here is that vision entries are in blue. So I'm going to go back to renovate the kitchen so you can see it's blue. What we call hard data entries, property taxes, operating expenses, that kind of thing, they're actually in red when you first create an entry in the tree view. Let me just throw in Sunbelt Home as an example. So you can see now all these different entries are red. So what happens is, as you go through and quantify entries, what applies to the client, then a blue entry, vision, or a red entry, hard data, ends up the marker ends up being displayed in gray. So the whole idea, of course, is to start on the joint tab, most likely, work your way down through Holmes, etc., then go to Bill, go to Sue, go to Bill Jr. And the objective is to go in and get rid of any color. So this color coding system is really important. It's just a visual clue to you as to what needs to be looked at, what needs your attention. I want to talk briefly about two other entries, which are the beneficiary entries for things like TFSAs, RSPs, DCPs, LIFs, RIFs, and so on. They are actually trusts. And as trusts, therefore, you get to put in a beneficiary of the trust. Now, if you're importing from one of the questionnaires, what you'll find is that automatically the transfer is selected because we can see that Sue has an RSP or TFSA as well. And so we can, indicate that it's going to be a transfer. But the problem is when you're first creating a plan where you're not importing, if I add a TFSA 2 for Bill, then what you'll see when I go to beneficiaries is that it's being transferred to Sue because we know that Sue has a TFSA. However, if we're just starting our entries from scratch and we add a TFSA for Bill, but have not yet added a TFSA for Sue, then what's going to happen is we can't do the transfer. We don't know she has a TFSA. So the default entry is going to be take lump sum. And generally, that's the least likely entry. Generally, it's going to roll tax-free into Sue's TFSA or RSP. So be heads up about this, because if you're talking an RRSP and it's take lump sum, then all that income is going to come into Bill's estate. The amount in the RSP will go to Sue, but the income will be taken into Bill's estate in the year of death and be fully taxed. So when it comes to things like TFSAs, RSPs, DCPs, or whatever, my recommendation is that you go in and you create them, add Bill's TFSAs, RSPs, then add Sue's TFSAs, RSPs, and then go back and quantify them, because when you go to the beneficiaries tab, then you'll know that there is a TFSA for Sue. So then you'll be able to go in and select it and do the normal transfer. While we're on the topic of TFSAs and RRSPs, let's use an RSP for this example. What I want you to notice is that there are two entries: your dollar contributions and unused contributions, and these are different. And if we go to the Rsp limit in terms, for instance, the Rsp limit tab, we can see here we can put in unused Rsp deduction. I'll just throw in $50,000 for a number. And also on the details tab, I want you to notice when it comes to type, this is an RRSP. But if I were, for example, setting up a spousal RRSP, where Bill is contributing to that RSP for Sue, I would go to Sue's tab, I would create the RSP, and then I would open the list and select spousal. And I'll just make this a dollar amount that Bill contributes. And when I select spousal, notice that the spousal contributions entry is now in the tree view. Thing to remember, just, who is, what type of RSP is it? It's an RSP, Lyra spousal RSP, locked in RSP. Now, let's go back to Bill. The reason for the your dollar contributions entry and the unused entry is because the dollar contributions entry is intended to be the year in and year out contribution that can be made subject to maximum limits. So by selecting the maximize checkbox, then we get to put in whatever that amount might be. I think the spousal. Anyway, so this is your year in and year out ongoing kind of entry. Now, if you want to clear this or change it, if you've selected maximize, you need to deselect maximize, and then you can go in and change things however you want, put in, for instance, 10 grand a year or something like that. Get rid of all of these future dollar bill bundles. The reason for these dollar bill bundles is that in the background behind each dollar bill bundle, there's actually an earned income calculation going on for the year before the entry year. We contribute based on earned income for the preceding tax year. So that's why there's the little dollar symbol, is that behind it, it actually represents the math that's taking place. So the reason then for your dollar contributions being just the current amounts, subject to the legal limit, is so that you can select maximize, everything goes in, and then separately you can talk about unused contributions. And the reason for unused contributions being a separate item is because it might not happen for a number of years. You might be planning on downsizing a house at some point in the future, and therefore you'll have the ability at some point to have a cash takeout and make up the unused room. Or maybe you're expecting an inheritance, or whatever it might be. So typically making up unused room is because of some event that happens, an inheritance, downsizing a house, so that now you have extra cash and you can go in and use it for unused room. What I want to do next is talk about the right-click menu. And this is, I think, very handy and very important when it comes to planning. And I'm actually going to go to 6 Hour Street, and we'll use our renovate the kitchen entry. So there are a number of things on the right-click menu, and you have the ability to go in and edit text. So, you can make that whatever you want it to be. But I also want you to notice this edited item. So once again, let me just get rid of this entry. And what I'll do is I'll just create a new renovation entry. And notice the markers in blue, not yet quantified. Well, if, for instance, I go in and create a home on the join tab, and it defaults to JTWROS, Bill and Sue being equal owners, which would be correct, then I don't want to have to resave something, enable the save button, or whatever I would have to do to get rid of the blue. All I need to do is right click, left click, edited, and then the blue would turn to gray. So again, let me just create the Sunbelt home. So you can see ownership, Bill and Sue 50/50, JTWROS. Yep, that's correct. So I can right click, left click, edited, and now the ownership entry is gray. There may be something that I have, which I'm pretty sure about, but I'm still not 100%. And this might turn up, for example, with second marriages and blended families. So remember, I can add a note, but if I want that visual cue in the tree view, then I could left click and deselect edited. So that's in red, meaning this still needs to have my attention. And then at the same time, I could add a note about it. You can also see, of course, there's the ability to delete an entry. One of what I believe is absolutely the most important features with the right-click menu is the include-exclude feature. And the reason I think it's so important is because when we're dealing with a plan and we're dealing with a couple, in order to create a plan, we need 2 points. We need the starting point. What are you worth today? What are your financial resources, et cetera? What are the things you do? And we need the end point. What are you planning for? What's your vision? What are the things you want to, have or do over time? So we need those 2 points in order to resolve any, issues or gap between where people are and, where they want to be. The problem is in that there's an underlying assumption, and the underlying assumption is that when we put in entries like renovate the kitchen, couples will 100% all the time absolutely agree on what that means. And that's not my experience of life. My experience of life is we want to renovate the kitchen, agreed. Okay, when do we want to do it? Oh, this year? No, not till next winter. You know, how much do we want to pay? $25,000? Are you kidding? I want to pay $100,000. So what advisors do when they have a goals conversation with clients in order to arrive at the endpoint, which they need to be able to go and create the plan for the client, what they do is they try and reconcile people's different points of view. Why do you feel that way? Why do you feel that way? Could we saw this off in the middle, let's say $75,000, you know, try and come to some agreement. I need agreement because I'm going to go, I need the endpoint. I'm going to go away and create the plan for you. So I know I need to know, you know, what we're planning for. So what we've done instead is, you know, one person says $25,000, or let's use 20,000. And then the other person says, no, $100,000. So we'll create, I'll just call it renovate 2. We'll add it in. And then what I'm going to do is I'm going to make it next year. And I'm going to make it next year. And I'm going to increase the amount to $100,000. Now, it's impossible to come to some conclusion as to what we should do, what's affordable, and so on, simply by talking about something in isolation. So you have the ability then to put in both points of view. You don't need to, you know, reconcile them, which takes time and I believe always results in a winner or a loser. If the $100,000 person compromises at 75, you know, there's a very good chance that they'll look at the plan and say, this is no longer my plan, I want 100. And they can at least mentally drop out of the planning process. So what we talk about instead, rather than reconciling different points of view, is acknowledging them. Oh, you want to talk about a $20,000 renovation this year? You want to talk about a $100,000 renovation next year? No problem. We'll put them both in. And when we have our next meeting, after the plan is fully loaded, I've got all your portfolios in here and everything else, all your financials are completely entered, you know, everything is looking solid as far as the financial forecast is concerned, then what I'll do is I will exclude one and we will look at the financial implication. You know, we would look at income assets in that case, and then I would create a new solution if I wish, exclude the second one, include the first one, and, you know, look at the financial forecast or go to the compare tab on solutions and compare the two. So you have this ability then to use include and exclude. And the key word is to acknowledge different points of view. The next right-click feature that I want to look at, is the move to feature. So actually, I'll do that with the vehicle. I have to move the whole thing. That's with the house, I'd have to move the whole house. So I'll go to vehicles. We've got it on the joint tab. And what I'm going to do is I'm going to go to move to and say, oh, I put it on the wrong tab. It should be on Bill's tab. It's Bill's car. So now I no longer have that entry on the joint tab, but I do have the car now on Bill's tab. So if you do put an entry in the wrong place, you put Bill Jr.'s education on the joint tab because Bill and Sue are paying for it, then all you need to do is right click, do move to, and then you can move the education entry to Bill Jr.'s tab. Now, this is for things like income and expenses. When it comes to assets, that's different because assets have that ownership interest. So let's go back and we'll recreate the Sunbelt home and do that again. So I would just go and delete bill. Now it's 100% Sue. And when I click save, we won't see the Sunbelt Home on the joint tab anymore. It disappears and we go to Sue's tab and we see the Sunbelt Home now on Sue's tab. So moving assets is different from moving things like cash flow type entries. Another thing we want to look at is the ability to copy entries to other solutions. And this is very important. Let's say you created a few solutions and then you've discovered, for example, that people have a mortgage on their house that you didn't know about, whatever it might be. So in this case, I can right click on 6 R Street or right click on the mortgage, and I would be able to click copy to, and then go in and copy that entry to other solutions. So, it's not uncommon that you may have created the initial vision or whatever you want to call it, a few other entries. And then when you're working with clients, all of a sudden they say, oh, by the way, did we tell you about? And at this point, you've got a number of solutions and you don't want to have to go in and, rekey that particular thing. You have the ability then just to right click and do a copy to another solution. One more thing that I'm going to talk about, and that's questionnaires. So if you take the interactive approach to planning, when it comes to homes, lifestyle, family, and career, most of the entries are going to be vision type entries. We want to renovate the kitchen or whatever. And I call those things made up. It's just what people would like to be able to do. On the other hand, there are entries like property taxes and operating expenses. So let me just deselect edited, turn those red. And these are things that you would actually have to have clients look up. I don't think I know anybody who walks around knowing what their property taxes or operating expenses are for their home. Now, what happens in other software is the questionnaires are put at the beginning of the process. And the downside of all of that is that to the degree that you're working with robust software, you need a question for everything that the software can model, and therefore questionnaires can be very long. Nobody likes to complete questionnaires. You give a lengthy questionnaire to a client at the beginning of the process, that will turn them off right away. They might be diligent for the first few pages, but then they'll just start scribbling answers to get through the thing. And also, if you're dealing with a prospect or a new client, you may not yet have developed your relationship with them sufficiently that they are willing to reveal all of their assets, for example, so they can hold things back. So in our approach, we don't give clients questionnaires at the beginning of the process. We have a conversation, let's add your house, let's talk about, whatever, the kitchen renovation. And then when we go down to something like other and bill, oh, you've got an employee share purchase plan at work. Okay, I'm just going to add that in. So we don't try and quantify anything when it comes to tax portfolios, other assets, pension plans, insurance. Those are all, kind of hard data things that people have to look up. I see I've got 2 employee share purchase plans. So the way questionnaires work is then, rather than having them at the beginning of the process, keeping in mind in the first meeting, we're going to talk about, their homes, things they want to do, vacations for children, vacations they want to take, education for children, and so on. Not quantified ends up then being added to the questionnaire. So you can see insurance and operating expenses for the vehicles we put in, the financing entries, anything related to, let's say, TFSAs. And if we, scroll forward, those are more TFSA questions. But you can also see, sorry, my mouse is a little freaky, that the property taxes and operating expenses where I deselected the edit checkbox are now added to the questionnaire. So what that means is that we're actually creating, here's our employee share purchase plan. So we're actually creating a questionnaire that's customized for the client. So we can talk about vision entries with them, very conversational. Then we can add any of the financial stuff, and then anything that they need to look up, like property taxes, operating expenses, anything about their employee share purchase plan, et cetera, that those things then are added to the questionnaire. So that keeps the questionnaire very short. And by moving it to the middle of the process, what we've actually done is we've motivated clients to complete the questionnaire. We've talked about the things they want to have and do in life. Now they're looking at it, are we on track, not on track, and so on. And the only way we're going to find out is to come to the next meeting, and beforehand, we need to have supplied you with the best information we can so that you can assemble the best financial forecast possible. If we give clients the questionnaire at the beginning of the process, they just don't have that motivation. The other thing is, if we're working with an existing client, if we click review, then what will happen is that we'll have a review worksheet, and that review worksheet will have any of the entries in it, like, what do you pay for property taxes? What are your operating expenses? Whatever it might be. And these review worksheets, by the way, can be saved as an XLS file and sent out to clients. They'll have two columns, the existing expense and then the other expense that the clients want to put in. So we're almost at an hour. It's a long session. I appreciate that. But I'm just going to talk very briefly about the main bank account. And I just want you to remember that back at settings, if you're dealing with a couple, then the default is joint bank account. It's just a lot easier to control cash flows rather than having individual bank accounts, which you could do if you wish. But if we go to the main bank account, all cash entries flow into it, all expenses come out of it. And this is extremely important because we want to be able to say, well, what are we doing with any excess cash? Or in retirement, where do we want to draw, what do we want to draw down from, TFSAs, RIFs, whatever it might be, in order to top up the bank account so there's enough money in it to pay our expenses. So just remember that the main bank account is the central processing engine for all cash flows. Paycheck into it, groceries out of it. If there's any money left over, where do I want it to go? And when we get into the advanced training, and we actually touched on the main bank account last week, but when we get into the advanced training, what we'll be talking about is the ability to direct where you want excess cash to go, or particularly in retirement, what sources do you want to draw down from, first of all. Good day. Thanks.